AI tempers Trump's affair, tariffs. At the beginning of the year, the world was in striking agreement on one point. If Trump went ahead with tariffs, it would strengthen the dollar and tariff stagnation. Chief executives, investors, and commentators all said the same. Economists estimated that every percentage point increase in the tariff rate would shave 0.1% of US growth and add zero point 0.1 to inflation. But so far, the consequences have been less disruptive than just about anyone expected. Some analysts think that that's because Trump's tariff threats have been most posturing. But the effective US tariff rate has already risen from 2.5 to 15%. Tariff revenue is rolling in at an annual rate of $300 billion, roughly four times the pace this year last year. When economists had assumed that by lowering imports, tariffs would strengthen the dollar almost automatically, as an accounting identity. Instead, it suffered its worst fall over the first half of a year since the early 1970s. This unexpected turn is now attributed to the fact that the dollar started the year historically overvalued. Many foreigners were heavily exposed to dollar assets. Of late, they had been hedging those risks and been investing more outside US. Many countries are increasingly attractive places to park money, in part because tariff threats inspired them to push economic reforms and cut trade deals with non US partners. The biggest mystery is why the stagflationary impact of tariffs has yet to materialize in the aggregate data. Is US really enjoying a free lunch, taking in $300 billion a year in tariff revenues with none of the expected heartburn? While some estimated foreign exporters are indeed absorbing 20% of the cost, a much larger share than they did in the response to tariff in Trump's first term. The remaining 80%, however, is getting paid in roughly equal shares by US corporations and consumers. The likely answer is that the negative economic effect of tariffs is being consumed by other forces, including the mania for AI and a more government stimulus. Since January, estimates of what the big tech companies will spend this year on build out AI infra have have risen from 60 billion to 350 billion dollars. Smaller businesses are scrambling to catch the wave too, further boosting growth. And all this excitement to neutralizing the fear that trade policy uncertainty would dampen almond spirits and freeze the new capex. AI driven bullishness is also lifting growth, keeping financial conditions loose, even with higher interest rates. According to the new index from the Federal Reserve, those conditions would be neutral, not loose, were it not for the stock market, which has continued rising this year, largely due to AI stocks. Meanwhile, the promise of tariff tax relief makes it easier for your corporation to absorb a larger than expected share of the tariff costs. Rather than pass it all on to the consumers, Trump's big, beautiful bill is expected to save US businesses more than $100 billion this year and more than in 2026, mainly in tax breaks. That is not to say the tariffs have no negative impact at all. The costs are in fact starting to show up in higher prices for major household appliances, snorting goods, and toys. Yet the overall inflation rate has been held in check by falling rents and prices for other kinds of goods, including used cars and energy. Those prices are declining for reasons unrelated to tariff. Used price cars are still retreating from high created by supply disruptors during the pandemic. The unexpectedly mild impact of tariff in US is also minimizing the worldwide ripple effect. After slowing at the start of the year, global growth is accelerating again, lifted in parts and ironically by US firms pushing to place import orders before the tariffs hit. More importantly, the falling dollar means foreign central banks don't have to worry so much about their own currencies losing value, which frees them to cut rates. In three out of four three out of every four major economies. The market now sees rates falling lower in 2025 than expected in Jan. India now expects to have cut 0.25%, up from 3 at the start of the year. Still, economists were not entirely wrong about the tariffs. Stagflation may yet strike in US, particularly if the average effective rates continue to climb. But so far, even a much higher rate has been enough to overwhelm the larger forces sustaining growth and containing inflation. In a way, what we are seeing is a replay of 2023. That too many expected a big shock, then mainly from the Fed rate rises to dramatically slow US growth, only to find impact offset by the AI spending boom and US's government seemingly bottomless capacity to keep doling out fiscal support. But the world's got wrong, then and now starts with its mental frameworks. The time worn mistakes of the employing simple models in which a headline grabbing inputs A leads in a straight line to outcome B has been greatly magnified by the global obsession with Trump. He's only the output anyone cares to analyze anymore. But complex economies are rarely shared by just one factor, not even as shock as big as Trump's tariff.